It's a pleasure to have with us Marty Leclerc, the founder of Barrack Advisors, an investment firm based in Philadelphia. Marty, welcome.
Thank you. Good to see you.
It's a pleasure to have you here. Before we get into discussing your approach and some specific value ideas you have for us, tell us a bit about your background and how you got started in the business.
Well, I started the business right out of college in Washington, D.C. 1,000 years ago. And back then, as a stockbroker trainee, I was sort of the new generation of guys who started in the business after the great bear market of the 1970s. I started in 1979 right out of university. And the office at that time was myself and a couple of other young guys who were trainees, and then everyone else who had were guys who had fought in World War II, and they were like mature men when they had fought in World War II. So there's a big age gap because a whole generation of investors had been wiped out by the 70s. And so we were sort of taught the sort of the corporate speak thing, but also the guys in the office who were the survivors would come by my office and throw a book, be like, the intelligent investor, and say, don't believe the rubbish, and that's not the term they used, that they teach you in New York, read this is all you need to know. So I built an advisory business, and then I got into a kind of, at a young age, sort of floated into management, and I had a career which took me to London and other great places, and but the whole time I was around money management, and I was still managing money for myself and a few clients. People were always saying, why don't you just go out and just manage money and forget this management stuff? And so about 2 years ago, I left Deutsche Bank and started Barrack Advisors.
So let's talk a little bit about your approach. And the world is quite uncertain, and from where you sit, with your experience and perspectives, where are you finding value?
Well, our number one concern is to preserve real wealth over time and compound it. And so first thing we do is and the way we do that, is by what we say to clients is, our job is to choose from among the world stock markets great businesses selling at good prices and good businesses selling at great prices. And we view the world as one place. So to us, L'Oreal and Estee Lauder, for example, are vanity businesses, and not a company that happens to, not a company in New York and not a company in France. The big investment banks, you get a research report, it's a different person who's following those companies. So we see the world as one place. So in our search for trying to find great businesses at good prices, and typically what that means is we're looking for companies with very, very strong balance sheets that have a business model that is of an enduring, lasting business, but high return on invested capital, very, very profitable companies. The first thing we do is we frame the world as being a place where, so our view is that for the first time really since the reign of Caesar Augustus, when Jesus was around, the whole civilized world is materialistic. In the Middle Ages, in the West, people were concerned with things other than making money. As recently as 1989, great stretches of the world was under the sway of communism, and now the populace of pretty much everywhere, and particularly and significantly the big population centers like China, India, Brazil, Indonesia, people are demanding the staples of a better life. So we're essentially playing the theme of this global migration to the city. And hundreds of millions of people, as everyone knows, are going to be going into the city, and people going from $1 a day to $10 a day in income will have a big effect. And so, including geometric growth in middle class amenities, the needs for middle class amenities, which would be things like education and transportation and travel and personal security and vanity products, toothpaste, things like that. So we essentially play three themes, or look at the world that way. One is the rising demand globally of the staples of a better life. So our sort of blue chip investments, our companies that we really sort of sink our teeth into, which probably comprise around 40% of the portfolio, are companies that cater to this demand for the staples of a better life. The second type of company that we invest in are this demand for the staples of a better life, or prosperity, is going to require an infrastructure. So we look to infrastructure, and we define infrastructure as sort of toll takers, so to speak. So you have, you build something, and people will pay to use it. Now, a lot of toll taker businesses, like locally in Philadelphia, you get the New Jersey Turnpike and the Pennsylvania Turnpike. Those are crummy businesses because they consume too much capital. Electric utilities, particularly in the developed world, tend to be lousy investments in our opinion because they consume too much capital. They're constantly, you got to feed the beast. So we like, so the way we define infrastructure would be like financial exchange operators, which are lovely businesses in our opinion because they generate net cash. We love, distribution networks, ports. Ports are a beautiful business, that sort of thing. And then the third type of business we invest in, apart from companies that cater to the staples of a better life and infrastructure type investments, are that this trend will create scarcity. And will be scarcity, along the global agricultural value chain, but also scarcity in terms of certain luxury experiences. And so that's another thing that we think about.
And taking one or two of these types of investment categories as you define them, can you give us an example so we can understand how that leads to specific investment opportunities?
Sure. So the first type of company is sort of our bread and butter, and that's the type of company that it's either just like a very, very palpable blue chip, a company that's been in business for a long time, that generates a lot of cash, that pays a good dividend, because everything we do too is also framed within what we call the 5 enduring principles. So an example of a company that we very much like right now is a company in Belgium called Van de Velde. And Van de Velde has been in business for over 100 years. The founding families control something like 55% of the stock. And they've been public since 1996. And the thing we like about it is that to us as value investors, if you have a company, you have to have growth. Growth is very much part of the value equation. So a company, for us, a value stock without growth is a value trap. And the beautiful thing about Van de Velde is that if you look over any reasonable period of time, the last 5 years, the last 10 years, the last 15 years, the way we measure earnings per share and cash flow and dividend growth, it's been growing at roughly between 9.5% and 11% compounded since they went public. So they have a great track record. It's a small cap, call it 500 million euros. Net cash of, call it 60 million euros. So there's no debt on the balance sheet, very, very clean. Pays a dividend of, at this price, of somewhere around 5.5%, and it's trading for 9 times earnings. What Van de Velde does, that's really what gets us turned on, hot and bothered, is the financial metrics. But what they actually do is there's a moat around their business. Well, first of all, as any self-respecting value investor, we always want an edge in the companies we invest in. But furthermore, as an American sitting in Philadelphia, I have some European clients, but really most of my clients are American. I need a compelling reason to invest outside my home country. And valuation clearly would be part of the equation. But the other thing is that the country has to have an edge. So what I mean by that is, For example, let's say you had a hankering to own a watch manufacturer. The last thing we would do is start Googling watch manufacturers in Zimbabwe, for example. We would look to Switzerland. So Belgium does three things really well. They do beer, chocolate, and lace. And Vandeveld makes women's underwear. And they're very high-end, and the barrier to entry is that evidently it's a very difficult process to do profitably because they're one of the few global manufacturers that are consistently profitable at doing this.
And can you talk a little bit more about the business itself? Where do they derive most of their revenues from, and is this perhaps also an opportunity because of the European crisis that people just sold it and don't really ask much what the business is and where the revenues are coming from?
Well, their business model is their manufacturing is in Tunisia. It's very state-of-the-art. And the revolution in Tunisia worked out well for business, I think. You know, the one thing to Islamist governments is that they tend to be honest. Stealing is a crime and serious crime in Islam, and so I think because some people say, okay, well, their manufacturing plant is in Tunisia, whoa, but I think that's actually a major positive. So they keep costs down that way. It's been a couple of years, frankly, that since I looked at their actual product mix in terms of sales, but my gut would be that probably half their sales, maybe 55%, are still in the European Union. Their business, though, and that's actually been growing pretty well because it just has. Their American business has actually been their problem, and because of the American business, this year their earnings are not going to go up versus last year. But we don't look at stocks for this year's earnings or next year's earnings. We we do the Benjamin Graham 3 years earnings, divide by 3. That's what the earnings are, and so the stock is down partly because of that. But I think also small cap European companies are just really out of favor right now. It got as low as sort of 26, 27 in March of '09. It's now, call it 32. So we love owning it at this level.
You said they're one of just a few of these types of companies globally. Can you give us some sense for competition and what really allows them to compete effectively? What really comprises that moat?
Well, their biggest direct competitor in Europe is a company called Calida, and they are based in Switzerland. They're sort of, and it's a little bit like, they and Calida are, Ferrari and Lamborghini, and then everyone else might be like Mercedes, So that's really their competitor. Calida has been an okay business, but they kind of went off the rails in '09 in terms of their balance sheet, their profitability. They don't have a balance sheet that looks like, it's not a beautiful balance sheet. Their other competitors would be like Arkel, which is an American company that actually has always been up and down, and I think it's a crummy business. So in that space, it's the only company that I would own.
Is there much threat from, if you will, other entrants into that business? I know in the UK, for example, you have Marks and Spencer, who sells food, but they also sell, I think quite successfully, women's.
Right, but they're in the market level, the market segment above that. So there's a fancy. I'm having a Rick Perry moment. I can't remember there's a high-end manufacturer, a retailer in London that you would probably know that they own them. So I'm sorry, I forget the name.
It's not really. the end of the world, but just wondering, I guess, so it's really that focus on the high end and the brand that allows them to have an identity and compete effectively. Is that it?
That's it.
Okay. You mentioned Europe, and I'm wondering, have you looked more systematically at Europe, given the crisis, to uncover any opportunities there?
Yeah, I'm so ready to pull the trigger on buying some things in Europe, and I may sell some of my American stocks to fund the purchase. I mean, right now, overall, in terms of portfolio construction, an average account, I want to have about 20% in cash because we do have the fiscal cliff thing in the U.S. that could materialize, although the problem in Europe is well publicized. You could have an oopsie moment, so I do want to have some liquidity. But at the same token, one of the many things we look at, particularly long-term, and clearly long-term indicators give you some comfort long-term, but not in short-term, right? It can be long and wrong in low valuation situation, and it doesn't end well if your clients get impatient. But the thing we're very mindful of is, right now using CAPE, which is the cyclically adjusted PE ratio, American stocks are neither cheap nor expensive by historical standards. I mean, we're half as expensive as we were, 10, 12 years ago, but we're twice as expensive as we were in 1982, for example. So, we're not negative on the U.S. stock market, but we're not, raging bulls. We don't think this, we kind of think equities as an asset class has to be completely discredited before you're going to have a sustainable bull market. And so we don't believe we're there yet. But we like selectively buying companies in the U.S. as well as outside the U.S. Now, by comparison to the U.S., Europe to us is really kind of exciting because using CAPE, European stocks right now are so much cheaper than they were 10 or 12 years ago, and only are something like 20% above their lows from the early 80s. So to us, that's pretty exciting. Now, a lot of these European companies, get less than half their business from Europe. So even if their European business is crummy for a while, we don't think that's being properly reflected in the marketplace.
And so when you look at Europe, how do you focus your search? Are you going to the eye of the storm, Spain, Italy, or are you attracted to Northern Europe? Can you give us some sense of how you would go about finding the right opportunities?
So the trouble with Spain is that they make some really nice red wines, but except for maybe Zara, they don't have any world-class companies. And so they've been sort of living off the conquistadors and that legacy. And so. Now, Italy has world-class companies, so we're more sanguine about Italy, but the problem with Italy is that, and my mother-in-law lives in Tuscany, so but it's a little bit like, I read once that investing in Italy is a little bit like driving with the parking brakes on, It's problematic. And the only Italian stock that I've ever owned in the past that worked out was I owned Bulgari a few years ago and it got taken over by Louis Vuitton. So we like to go to places that have an edge. So France, for example, has great world-class companies in the vanity business. Agriculture has if we were to do nuclear power, which are not right now, areas like that, they're world-class leaders. Switzerland, the pharmaceutical industry, the watch business, the private banking, any number of great industries. So the countries that we tend to favor are the countries where the great businesses are. And the great businesses are in France and Switzerland, and historically that's kind of where we've found great value. And that's also, now the great thing about, to a lesser degree, France, but also maybe Belgium, is that, and they're expensive now, but one thing that we keep our eye on is Africa plays, because a lot of the great Africa plays are actually European companies. And SIPF, which is a Belgium company, you know, I'm just mad because I didn't buy it when it was 30s because I wanted to buit when it was in, you know, I thought it was going to go maybe hit the 20s, then I buy it then, and now it's in the 60s. So that's how we think about the world, and is again, you know, we have the theme about staples of better life, infrastructure, and scarcity, and the companies that cater to all that, or ways to play those themes, happen to be typically located. So we're not again. If Italy had great companies, or Spain, I wish I could buy a company like Van de Velde in Spain, because it might, instead of be trading at 9 times earnings, might be trading at 6. But also the market's smarter than that too. So maybe.
So when it comes to these high quality businesses, whether France, Italy, or Germany has lots of great businesses as well. You haven't found the right opportunities because they're perhaps not cheap enough.
Not cheap enough. Like, for example, L'Oreal is a name that I loved and owned a lot of 10 years ago, but it's too expensive, you know. But, you know, we're looking at some that are not so expensive. The couple of UK firms, you know, even though I lived in the UK for 9 years, I bought my first UK purchase was maybe 2 years ago, which was I started buying Tesco because their competitive edge is that their nation of shopkeepers, right? And Tesco's a great shop.
How do you go about finding those opportunities? Do you have a database of companies that fit these categories that you talked about, or do you use screens at all? What do you do?
Well, the first thing foremost is that years ago I climbed to the summit of the Grand Teton in Wyoming, and the guy who, and you have to have a Sherpa who leads you up. And the guy who led us up was in his 70s, and at the time I was, you know, in my, you know, just 40 and late 30s even. And this guy was so fit, and we get to the summit, and at the summit the sort of paying customers kind of hang around, and the Sherpas all hang out, and he was the oldest one, and you could tell the younger guys really looked up to him. And they said, his name was Dean, and one of the young Sherpas said, "So Dean, what do you do in your days off?" And he said, "Well, I like getting outside and, you know, climbing mountains." So you know, what I like to do is I like, you know, researching stocks and reviewing regulatory filings and things like that. So the thing I do is first of all, it's a real passion for me. So you know, finding, you know, a company selling at a good price, that's a great business. That, you know, that's a new idea to me, is like viscerally just, you know, gets me. I just love that. So investing is both, you know, math, simple math, and art. And we do screens. So, you know, the screen I did the other day was for companies selling for less than 15 times earnings that have a return on invested capital above 15, you know, things like that. So I'll do screens like that for fun, and then see what names come out of the hat. But a lot of it is, and I do have a network of like-minded buddies. Not too like-minded, because you don't want someone who's not going to disagree with you. And in fact, you know, some of my best ideas is when I call buddies of mine and they trash the idea, and it's like, wow, that's great, you know. So, not that I think my buddies are idiots, but it's just that, and I'm sure I got pals who do the same thing to me, you know. So it's both a network that you build up over many years of fellow value investors. It's, you know, lots of reading, being interested in a lot of stuff, and haven't been around the world. You know, I've a lot of portfolio managers have done nothing but manage money their whole lives, whereas I've actually, you know, gone out and build businesses outside the United States as well as in the U.S. So I think that's been helpful as well to learn the culture and that sort of thing.
Mm-hmm. Can you talk about another example in one of the categories that you talked about, scarcity or infrastructure?
Sure. So the infrastructure idea I'll throw out is something that's very, it kind of demonstrates a couple different points. One is that I tend to get an investment idea, and sometimes it might take me 10 years before I can execute on it, a long time. And so about 10 years ago, even longer, I was going out to Dubai, and I met the fellow that sponsored my, the bank I was working for, the investment firm I was working for, as a local sponsor to open an office there. They owned a ports business, so they ran the ports business in Dubai. So I got very intrigued by it, and I saw that it could be a good business, a great business. But there's no publicly available way to trade ports or buy into ports until recently, except for the port of the Dubai ports, DP World, which is, you know, a different kettle of fish. But the other ports businesses were, well, the thing I learned of ports is this, is that first of all, you want to own a deep water port because the ships are getting bigger and bigger. So the second thing you want to do is you want a port that's part of a global network. So there are some pure plays in ports, I take that back, but I rejected them because they're too provincial and they don't have the economies of scale, because there is an element of economies of scale. So about 18 months ago, I read that Li Keqiang, as part of his, used to be the richest guy in Hong Kong, been called the Warren Buffett of Hong Kong. Anyway, he owns a couple of holding companies, and they're trading at big discounts to NAV. So to try to pump shareholder value, he's been spinning out some businesses. So he spun out the port of Hong Kong and the port of Shenzhen, which is across the Pearl River Delta from Hong Kong, into a Singapore-based trust called HPH Trust, Hutchison Port Holdings Trust. This was like in February of 2011. So it went public. I read the prospectus. Looks like a great business. And at the time, it came out at 95, 96 US cents. It trades in US dollars in Singapore. Now it trades in both. And we love Singapore because there's no withholding tax, and they have the rule of law. And Singapore, to us, is a really great place to invest. Great companies. So it came out at, like, call it 96 cents. By terms of prospectus, they said they're going to be paying a dividend of more than 6 cents a share this year, 2012. So we thought, okay, well, you know, let's take a look at it. We don't like to buy things at the IPO price. And then a year ago, in the summer of 2011, when particularly the Asian markets got trashed, it ran down to the 70s and in the 60s. And in the 60s, I thought, well, heck, you know, it's going to pay you a dividend of 10%, and it's supposed to be a growth dividend. And, you know, the one asset they have in China is actually majority owned by the Chinese government, which is a good thing if you're going to own a Chinese asset. So I started, you know, sort of getting my toe wet, and then I saw there was heavy insider buying, and then I just sort of went all out and started buying the stock. And so they are, you know, at the nexus of the world. And actually, and one of the things that made me feel good about, going back to the previous thing about buying the stock, is that when I called a lot of people, buddies about it, everyone said to me, yeah, but China has a real estate bubble. So I thought to myself, okay, they're trashing this idea because China has a real estate bubble. How does that affect the Walmart shopper, you know, because that's what the throughput is. That is not a function of the real estate market in Hong Kong or Shanghai, right? So that's an example. So Hutchison Port Holdings Trust, you know, it's a toll taker business model. Doesn't consume too much capital. In fact, it generates, you know, cash, pays a nice dividend, and if the world has, you know, if from all this, you know, central bank pumping of money into the system, if the unintended consequences is that we have inflation, then this will be a good inflation hedge. And, you know, if we have deflation, their debt situation is not so bad that they can't survive and, you know, navigate through that. And maybe the dividend goes down because world trade may slow down, but we feel very happy about owning, you know, a world-class asset where that's generating a dividend, even at current prices, of like 8%.
can you give us some more sense about that, the actual business? So how does a port operate? Do they even own the land? Do they lease the facilities there? And you talked about the toll taker model. Give us some more detail around that.
Okay. Well, ports are very much like airports, where the municipality tends to own the actual land, their long-term contracts, and that's the way it works in the ports business. So typically the lease might be for like 99 years and so forth, and the renewal feature is such that they have a huge competitive advantage because they're doing it, right? And HPH Trust has a proprietary way of handling cargo called NGen, which is really state-of-the-art. It's world-class. They're the worldwide leader, and they can move, product, faster than anyone else in any other port in the world. It's an extremely efficient port. So, in 30 years from now, will I start to worry? Well, probably in 30 years from now, I may not own this. I would hope that we're currently in a state of undervaluation. My idea is hopefully at some point the cycle will come that we'll be in a state of overvaluation in the ports business, and if that happens, then of course I'll be a seller, not. So I don't plan on holding this for 50 or 60 years.
Now, presumably this is a controlled company, and how do you get comfortable with management? What's the strategy here?
Well, one of the things is that Li Keqiang is sort of legendary, and I feel very comfortable with his ethics as a businessman and his reputation. So, for us, heavy insider ownership is a good thing. The Hutchison Whampoa still is a majority shareholder. They have some very impressive anchor investors as well. We feel comfortable because of the reputation of Hutchison Whampoa first, and then secondly, it does have a terrific track record, and the financials have been audited by one of the big, I forget if it was Ernst & Young or a firm like that. So we feel very, very comfortable with it. We also like the fact that they bill themselves, by terms of their prospectus, as a growth business. So although right now they're generating cash, and the dividend, which as I mentioned is very attractive even at current levels at roughly 8%, and they believe that they will be able to grow that dividend over time. So that's a baseline for them. They also have rights of first refusal for any development in the Pearl River. So, at some point they could be negative cash flow because they're making, maybe they build another port. But we just feel, reputationally, it's a good, solid business team. The insiders are putting their money where their work is, and we like sitting on a nice, fat, juicy dividend.
You talked earlier about the 5 enduring principles. Can you explain that?
Sure. So, from basically doing this and thinking about it for 30 years, I wanted to summarize really what I thought were, what's important. And so, and it may seem a little bit simplistic and a bit obvious, but I can tell you from my experience that a lot of investors lose sight of these things. So, the first thing is that the first principle is that valuations matter. That the price you pay for something is the biggest determinant into future rates of return. And if you overpay for something, and you run the risk that it will go to fair value, and then to go from fair value then to outperform the market after having been overvalued is a really, really painful process. If you buy something that is really cheap, that's undervalued, you always have the potential that it could go to fair value, which means that you have that little extra oomph. So valuations are the most. So we're very, very keen on valuations. The second thing is that we think reversion to the mean is the most powerful force in finance. So you look at gold, which is up 6-fold or so in the last 10 years. and the markets have done nothing, to us as long-term investors, that's telling us something. So we do that, between asset classes, but also within asset classes. So if we decide we have to own a beverage company, then, for example, we would look at Coke and Pepsi and see that historically over time, maybe Coke is cheaper than Pepsi or vice versa. That may lead us to buy Pepsi versus Coke, for example. The third most powerful, but the real way that we use reversion to the mean analysis as a practical matter is in relation to itself. So if we're looking at a blue chip company that's been around for 100 years, 200 years, and it's been consistently profitable, take a Johnson & Johnson right now, trading at 12 times earnings, 10, 12 years ago it was 30 times earnings, whereas historically people say, well, 15 or 16 times earnings. So we like buying blue chips at 12 times earnings if historically they've traded at 15, because if they have bozos as managers right now, if they're big powerful companies with a decent corporate governance, then the bozos will be gotten rid of. They'll bring in some competent people, and then you'll revert back to that mean and get that extra. And if the company's paying a good dividend while you wait, to us it's like that's a good thing. The third enduring principle is volatility is not the same thing as risk. We explain what volatility is it's the price you pay for liquidity. Risk is the potential for permanent loss of capital. So, as Benjamin Graham said, truly risk is that the world changes and the business model doesn't comport to that change. So, when I was a rookie broker, people would say, back in 1893, you could have owned the best buggy whip manufacturer out there with great financials, but you had been screwed, and they're absolutely right? So we're constantly thinking about, is this what this company does for a living? Is it of an enduring value that human beings will need or want for the indefinite future? So volatility is not the same thing as risk. The fourth thing is that careful investment selection trumps random diversification. So we believe that if you have 20 to 30 really, really great businesses that that gives you enough diversification, as opposed to what these big money management latifundias are telling you, that you have to own 20 different ETFs owning a million different individual securities. And then the final thing is the dividends matter. Dividends matter because 40% of the return in the U.S. stock market is from dividends. Dividends matter because cash can't be made up. And if you look at some of the big scams or some of the big controversial stocks over the past decade or so, WorldCom, Enron, they didn't pay a dividend. They also didn't have positive cash flow. So dividends matter. So we like them. So those are the 5 enduring principles that we kind of frame everything in.
What would you say is the single biggest mistake that investors make?
Lack of patience. You have to have the right psychology. You have to like misery in the markets. The times that I feel best about investing in the stock market is when my stomach hurts the most. It's like you get to the point of absurdity, right? It's like that's when what you're doing by hanging in there or committing more capital is the right thing to do. Viscerally I had that in March of '09, but even last October it got pretty scary and I in fact wrote a piece saying that I don't know what's going to happen. I never know what's going to happen with the stock market, but it just feels so bad right now. Is that it? Now it must be a good time to invest, and we've had one heck of a rally even in Europe since that time.
Now, one stock market that really makes a lot of people's stomachs churn is Japan, and you're a global investor. I'm curious, what do you make of Japan?
Well, the problem with Japan is that one of the things we love is profitable companies and companies that have high return on investment and high return on equity. And I don't own it right now, and it's one of those stocks that I've always thought about owning, and I've never pulled the trigger, and I've had regret in the past that I didn't pull the trigger because it did well, and now it seems to be trashed again, is Canon. But apart from Canon, pretty much, I mean, it's so rare to find a company that's consistently profitable and highly profitable, high teens ROIC and 20% ROE. I mean, that's, so Japan is a company full, you would think I would want to be in Japan. It has incredible companies, some of the best in the world. Miniaturization technology is just, sublime. I mean, it's just a great place. But their companies, for some reason, are not very, very profitable, and they don't have really so much of a shareholder culture either, where the owners get rewarded. The only Japanese stocks I've owned, I owned for a while the Osaka Stock Exchange, and during the financial, and I owned it going into the financial crisis, and it held up so well that I used it as a source of funds to buy cheaper ones. And I bought it despite the fact it really didn't meet my criteria for return on invested capital or any of the other metrics, but it's just sort of like I felt like I should own Japan, and at the time the yen was like at 120, and I thought it might weaken, so it was kind of like one of those plays as well. But I'd love to be there, but I just haven't found the companies.
Is there anything else that, in terms of opportunities globally, when you look, that catches your eyes? Any other specific companies or any industries where you see inefficiencies?
Well, the thing that intrigues us the most is agriculture. And I recently read a white paper on the, is the commodity super cycle for real? And I even forget the name of the author. But the thing I took from it was that it does seem like there are these commodity super cycles, and the last 10 years has been the beginning of one, and obviously it's been driven by China and so forth. And typically what happens is that, a couple things that caught my eye was that these cycles tend to be very long, like 30 years or so. And with agricultural commodities, they tend to be, the peak price level tends to be lower than the peak price level of the previous boom. So when I say agriculture intrigues us, I don't mean going long the agricultural commodities. And we wouldn't do that anyway because we don't buy sterile assets. We want things to compound. Our tagline as a business, Barrack Advisors, is compounding money by design. So, it kind of precludes me from owning sterile assets. But along the whole value chain in the agricultural market, we think that there's going to be great opportunity because of the fact that people are going from, when you go from earning $1 a day to earning $10 a day, you go from eating basically a bowl of rice every day to having some meat. And as 1 pound of meat, you need 13 pounds of grain. And for every bushel of grain, you need like 6 liters of water. And it just compounds the... So we're finding, the area that we would most like to invest, but the companies are too expensive, with one exception, but it has a little hair on it because it's owned by a French cooperative, is our seeds. I never knew this, but seed technology is like the most sophisticated, high-tech thing in the world. You can't just, be working for Monsanto and go off with your buddies and start a new seed company. I mean, excuse the pun, but it's really in their DNA as companies. Consequently, there are only 4 global manufacturers of any significance. There's Monsanto, Syngenta, BASF to a lesser degree, and Dow, and then there's Vilmorin in France, which on some metrics looks appealing, but again, it's the return on invested capital is not very good. But then from seed manufacturers all the way down to the farms. And the beautiful thing is that you can actually own farms through publicly traded securities. So one portfolio addition that we put in this year is a Brazilian company called SLC Agricola, and they've been in business since late 1940s. It's a quality management team. They first started they started partnering with John Deere in 1979, so that goes back a long ways. And they own 750,000 acres of farmland spread out among 16 farms. At the current price level, and by the way, their farms are great farms. They have enough water, they have perfect climate, their yields are better than American farm yields. So it's beautiful farm business. The average American farm in Iowa sells for around $6,800 an acre. At the current prices, you can pick up, particularly with the Brazilian real having been trashed a little bit recently, you're paying around $1,800 an acre for this farm. Now, the Iowa farmer and the Brazilian farmer are getting the same price for their commodity. Now, there are reasons why farms should cost more in the United States than these big farms in Brazil, but a 75% discount seems too extreme. And the nice thing about SLC is they had excess cash flow. They pay a dividend of 3%, which is variable. So there's some years, it's an up and down business. So they may not pay a dividend some years. But they believe that through cash flow, that they have a growth plan, so that within 10 years they will have grown from 750,000 acres to 1.7 million acres, 30% of which will be outside of Africa. They're opening their first farm in Mozambique this year. So they have this great growth plan. And Africa farming is, I think, something that is, a long-term trend. So that would be an example. And, are these the best businesses in the world? If you're looking at from what I said earlier, the answer is no. But instead of buying gold and having it sit in the vault, or owning an ETF or whatever, at least this gives me a fighting chance of, if sentiment changes, I can still compound wealth over time in real terms.
What is the main challenge then, if you will? You talked a little bit about preserving purchasing power over time. That's your overriding goal. What's an investor to do? Can you talk a little bit about that challenge today and how you deal with it?
It's something that's really, really tough. When I started in the business as a young man, stocks were very, very attractive. We were in the middle of one of the lowest valuations ever. But you could always put people in bonds. And so the way I built the business was, I basically was a bond broker and then would convince people to buy stocks, occasionally. So I could woo them into the stock market. Because you could say, well, let's buy this 9% tax-free bond, or this 10% tax-free bond. And oh, by the way, you should have some exposure to the equities market. Have you thought about owning this electric utility stock? It's paying 12%. So then, you get them a little bit pregnant on the electric utilities. Next thing you know, a couple of years later, they have a nice diversified portfolio of good stocks, right? So right now, though, we're in a zero interest rate world. The way we look at the world is that, and we realize that history doesn't repeat itself. It may not even rhyme. However, the thing that we would note is that the overriding mantra of the day is there's too much debt, and the economy's crummy. And in the late 1940s, there was too much debt, and the economy was crummy. People were saying, we're going to go back into the Great Depression, and oh, by the way, with national debt at 120%, which is bigger than it is even now, debt was higher as a percentage of national income than it is today. So what happened in the next 20 years after that? Well, what happened was government bonds went from sub 2%, like now, to 6% 20 years later. And what would happen is bonds would eventually go into double digits 10 years after that. by which time it was a completely discredited asset class, right? The bonds were called certificates of confiscation. So had you bought bonds in the late 1940s, you would have lost money in real terms, inflation adjusted. In the 1950s, in the 1960s, and in the 1970s, you'd lost money for a generation. Now, people can't imagine that because the bond market has been in a bull market for 30 years. You have to, I started as a broker at the age of 21, but there are, very few guys even my age know what it's like to have a client own a bond and have to explain why their bond went from par to 65 cents on the dollar just because, this guy named Paul Volcker decided to do something I had no understanding about what he was doing except it had something to do with fighting inflation. So most bond money managers, if they got out of college in 1980, let's say, they didn't get out of business school until 83, 84. They're now in their late 50s. So everyone that age, 60 years old and younger, have only known a bull market in bonds. So it's inconceivable to people that we could have a bear market in bonds, just as it was inconceivable in 1948 because the bond market had basically been strong for forever. So like today, stocks yield more than bonds. So what do people do? Well, I think one protection is to own some real assets, but real assets that are not sterile, real assets that pay you something. Hence why we like farming. If they got cheaper, we're not adverse to even looking at mining stocks, but we think they're too expensive. The other thing is we just think that if you own great businesses that you feel really comfortable that are going to be around, that can compound, that are paying you a good dividend, that have enough cash flow and will continue to have enough cash flow to grow that dividend, plus reinvest in the business, plus maybe buy back shares, I think that's the best protection that any investor can ask for. There'll be volatility along the way, going back to the example of the late 1940s. If you put the money, instead of buying bonds in 1948, instead you had bought stocks, 20 years later you would have had 5 times your money. That's about slightly under a 10% compounded return. But, 5 years later, it looked like a pretty stupid idea because the stock market was lower than it was. So you're going to have that volatility. That's just, but I don't think you have any choice because at interest rates where they are, there's no margin of safety. Unless you think we're going to suffer from 19th century style deflation. But we believe that that's not going to happen because politicians understand that people suffer from money illusion. And they would much rather get a 2% pay rise when inflation is 5 or 6% than agree to a 2% pay cut when deflation is 5%. That was true 100 years ago. There was a real life example that was done in the 1890s. It's true today. So, the policymakers and the politicians are going to do what it takes not to allow that to happen. So no matter how much of a deflationary abyss we're looking at, we believe that they're going to throw money at the fire to try to create inflation, which will then you run the risk of unintended consequences, which is that it could get out of control. Now, this is not a prediction that we're going to go into hyperinflation because I sort of don't think that. I think as a money manager, assuming you could try to buy protection for extreme events, because extreme events happens all the time. These 500-year events will happen every 5 years or so or less. But muddling through is kind of the way the world works typically. So we just think that you're going to have this slow wealth destruction, sort of like the old proverbial, frog being in the nice warm water and really digging it, and then by the time it's boiling, he's already dead and doesn't realize it. I think that's going to happen. That's what's going to happen to people who are obsessed with owning safe assets. That safe assets, we fervently believe that safe assets today, here we are in August of 2012, are not safe.
And by safe assets, you of course mean the bonds?
Bonds, government paper, and anything that's propped up by cheap money.
about these? So, well, some other people have recognized that and have flocked to the great businesses. And, you know, you mentioned that one of your enduring principles is the price, the importance of the price you pay. So, can you give us some sense of that dilemma of, yes, everybody wants to own great businesses, but they don't come cheap. So as an investor, then you don't have that safety in the end.
Well, I think earlier I gave you an example of a great business that's cheap, less than 10 times earnings. One thing I remember, you know, I can still remember 1982 because I was like, 25 years old. And so, at that age you remember things, and you particularly remember things that were sort of, I'd been a stockbroker at that point for over 3 years, and, every stock I'd ever bought was still down, kind of, by August of '82, And I remember later, a good friend of mine who's got a great sense of value, who's an old stockbroker, and he told me about when he was a young broker. He started in 1968, and his wife had gotten a little inheritance, and in 1973 is when she got it, and she said to him, "Honey, you think you could buy stocks that go up with this money?" But in seriousness, my argument is that in Europe there are great businesses that are not expensive right now. In the U.S. we've had this rally, the short-term rally. I'm not buying any American stocks right now just because they're all at the high end of, or higher than our buy range. So, of the blue chips that we have in the portfolio, Johnson & Johnson at 69, we just think maybe it goes to 90, and that's great because I've got a pretty big position. But for new clients, I'm waiting to go back to the low 60s. I think, one of the other things about being at the end of a bear market as a young man is that we used to have jokes about the markets because you had to. And one of the jokes was that the great thing about the stock market is that an opportunity of a lifetime comes around every 6 months. Because you buy a stock at 10, it goes to 15, within 6 months it's going to go back to 10, right? So I do think we're in that kind of the volatility is we're in volatile times because the politicians are really, the issues that need to be resolved, which are basically politicians have promised too much in the developed world, so we need reforms. And secondly, there's too much debt. Only the politicians can deal with it. So because of that, things are going to be more volatile than during the great bull market, certainly. But even the Johnson & Johnson at current levels, 12 times earnings, 4% dividend. Even in 1983 or 84, 4% dividend, 12 times earnings, that was not considered to be an expensive stock. And we were still, kind of like just coming out of a generational bear market. So I would argue that there are great businesses which are not necessarily expensive right now. Now there are great businesses that are very expensive right now. And also there's areas that I would be really careful about is, as I mentioned, areas that are propped up by cheap money. So the real estate investment trust business, for example. I mean, if I were to own an REIT, for example, Boston Properties would be one. I mean, it's a great name, great company. They own, here in New York, the best property. I mean, wonderful company, great management team. But over the last 10 years, they've actually reduced their dividend per share. But the stock's gone from 30-something to over 100. I don't understand that. I don't understand how, why that is why people are putting their money into REITs, except they're reaching for yield, and they're told, well, real estate is safe, it's an inflation hedge. Well, the problem is that real estate is also the other little factor of, cheap money and interest rates, and they're interest rate sensitive.
So we're back to the Van der Velds of the world, and characterizes a great business at a good price.
Exactly. Well, actually, I would characterize them more as a good business at a great price.
What are some of the resources or books that help you keep improving. You've been in the business for a long time. That help you perhaps improve your judgment when it comes to investment situations?
Well, I guess it's in the same way that perhaps a minister or a priest might go to the good book to get inspiration and so forth. Is I tend to go back to Graham and Dodd and Graham. So, the chapter on stock market investing in security analysis, and then of course the intelligent investor, particularly the sections on investor psychology. So they're big for me. My heroes who are kind of alive would be Robert Shiller at Yale, because he approaches the world from an academic point of view, but to me he's not trapped into the orthodoxy of what they teach at business school, which is the efficient market. Basically this, it's sort of like the holy tablets were found. In this case, it was the PhD dissertation by Batchelor, right, and that he did 100 years ago. And in the business world, academia has taken this wonderful tablet, and everything has to be based upon on those commandments. And but Schiller is someone who I read, and I go back to irrational exuberance quite a bit, just to frame things. But it's sort of like Graham and Dodd are really I've read everybody else, but I think that's what I go back to.
Great. Well, on that note, Marty, thank you so much for your time.